People's Utah Bancorp is a publicly traded community bank headquartered in American Fork, Utah, and has been in operation for over 100 years. They are the largest community bank in the state and have 26 full-service branches operating throughout Utah and southern Idaho. People's Utah Bancorp is the holding company for People's Intermountain Bank, which is comprised of three divisions: Bank of American Fork, Lewiston State Bank, and People's Town and Country Bank.
History of the bank, the thing that even attracted me, the company's been around since, 1913, I believe, so 106 years. Today, we're a publicly traded $2.2 billion financial institution with 26 locations throughout the state. We focus and have focused on the local communities, and if we look at a specialty area, it would probably be more home construction, real estate type transactions. And more recently, we've diversified into more commercial industrial type lending, and we've always done some of the consumer lending as well. Utah's market has been phenomenal for the last several years. It's been in the top several in the country as far as economic growth, personal income growth, business growth, in-migration, home value increase, a lot of great things. So that floats all boats to a degree as well.
Our earnings performance has been very strong the last several years. Salt Lake is a fantastic economy. We've been able to take advantage of that, and we've had consistent earnings increases year after year.
In late 2017, we closed on two deals. We bought 7 branches of Banner Bank and consolidated them into 5. And then we also, Banner Bank, we bought about $250 million in loans and $100 million in deposits from them. Pretty big transaction, but ate some of our liquidity up because we got more loans than we did deposits. And then we also acquired a small bank down in St. George called Town and Country Bank.
2018 was a record-breaking year for People's Utah Bancorp. Core net income increased from $28.1 million in 2017 to $40.6 million in 2018, an increase of nearly 44%.
The other issue that helped us a lot was, frankly, the tax reform. When we got a fixed lower tax rate, that sure went right back to our shareholders as well. So the combination of good people, good market, favorable regulatory environment was all very helpful for us.
As we look at Tier 1 or the leverage ratio, we have set the capital ratio above 11% given the risk in our portfolio, and we think that's appropriate. That's above what most banks would hold, but we are heavily involved with construction lending, and as a result, we think it's appropriate for us to hold additional capital.
You know, for a long time, you know, there was this guidance from the FDIC that 100% of your total portfolio of what we call ADC loans, acquisition, development, and construction loans, shouldn't exceed 100% of your bank's capital. And then additionally, your portfolio of what we call CRE loans, which is that ADC bucket plus investment real estate, that total couldn't exceed 300% of your bank's capital.
A lot of banks have gotten out of construction lending. We think that we're good at it, and as a result, have focused on that as a niche that we think provides a great return for us organizationally. Our balance sheet and our business is designed in such a way that we are taking on additional risk, and we talked about that with respect to capital. We internally believe that it's appropriate for us to hold somewhere around 125 to 150% Tier 1 capital for AEC, and we try to stay below 300% for total CRE overall. So the question is whether or not the changes in regulatory guidance related to HVCRE impacted the way that we were lending, and the answer is no. It did not impact the way that we were managing the portfolio or the amount of down payment that we were requiring of our borrowers.
This has historically been a very conservative organization in the first place. So the capital relief that came through a group of, we have always had excess capital anyway, so that really didn't impact us a whole lot. A couple places where it may have a bit, one would be on some of the electronic ease for our clients. We can open electronic accounts easier due to that. Some of the regulatory requirements historically on identifying your client, we can now take facsimile signatures as long as we identify who they are. So it's made that a little bit easier for us. The other thing it has done for the higher performing regulated institutions is we have an annual kind of performance exam or risk analysis that's done by the regulators. And those in the past were required to be done within 12 months of the prior. And the stronger institutions now get 18 months between examinations, and the stronger banks benefit from that too.
Senate Bill 2155 did not affect the mortgage department at Bank of America Fork. It didn't affect us because even previous to the bill, we were not delaying closings when there was an improvement to the consumer. So we felt maybe we were taking a compliance risk before the bill was passed, but we were not delaying closing.
I think the way we were managing ADC or HV-CRE loans before was consistent with the initial Dodd-Frank requirements, and so the relief that was provided, I don't think for us it impacted us at all, because we feel like we were following prudent underwriting guidelines.
The examination cycle is very important to our institution. It gives us a bill of health, it gives us a rating, kind of helps us know where we're at. This is having an 18-month examination cycle is a relief as opposed to the 12-month cycle, in the sense that it doesn't seem like there's very much time in between exams if there's a 12-month cycle. There may be some findings or recommendations that the examiners have had that the bank feels like they need to implement, and it may take a longer period of time to implement those controls than we thought. Just the sheer fact that it's very resource intensive. I mean, looking at how many people it takes to provide the examiners what they need to answer questions and to implement recommendations, it's fairly cumbersome. We're appreciative of the examiners and what they recommend, but it does take significant resources. So moving from a 12 to 18 month cycle is very beneficial, I think, for the regulators, because it ties up their resources the more they have to examine.
Probably the biggest area that we've seen a change is in the examination cycle, going out to 18 months for those banks less than $3 billion in assets. That has been a huge impact on the bankers. They love that. We as regulators, if the bank is in safe and sound condition, can go out to 18 months, and it saves on our manpower. We can concentrate on our efforts in other areas that are more important at the time. So those banks, I think, seeing us every 18 months versus once a year is a little bit of a regulatory relief to them, and has helped.
You know, looking forward-looking, if you're a strongly rated bank and not much has changed in the economy or with a financial institution, why not a 24-month examination cycle? And the examiners have access to call reports and to, if you're a public company, the quarterly financials and the annual financials, so they could see trends and patterns to see, you know, specific areas of the bank and how we're trending.
Senate Bill 2155, the story is yet to be written on how much relief has been provided to the community banks in Utah or anywhere else in the United States. Till we see where the community bank leverage ratio goes, we really won't understand the true effect of that bill and how it has impacted the community banks.
Whatever Congress can do to lighten our burdens as far as financial reporting, as far as other regulations go, would be very beneficial for us. That way we can focus on serving the community, and it's always a balance between compliance and providing what's required by the regulatory agencies and serving our customers, and finding that balance is the key.
You know, especially at Bank of America Fork, we want to help the consumer. We want to provide a place that's safe, that's fair, that's honest, and we feel we do provide that.
Dustin Phillips has been our banker for the last 10 years. Having that relationship where you have an individual banker that takes care of you on an individual basis, again, is a great customer service to me. It makes my life a lot easier. And so again, I value that relationship, and I value that they're my customers.
Our plans for the future really are kind of a three-legged stool. We've got three areas that we believe we can grow the value of the company. One of them is just doing better what we do. The next area where we have opportunities is to take that core competency and expand it into other business areas. I mentioned real estate. We can do the same thing with business loan. That's area number 2. And then number 3, we do have the capital and the appetite for continued acquisition.